Good afternoon. My name is Hallie Leinhardt, Outreach Specialist for the Center for Financial Security at the University of Wisconsin-Madison. Thank you for joining us for today's webinar, Leveraging Mobility, How Employment Builds and Protects Family Wealth and Security. Our presenters today are Erin Currier, Director of the Economic Mobility Project at the Pew Charitable Trusts, Hannah Thomas, Senior Research Associate at the Institute on Assets and Social Policy at Brandeis University. She is also a Research Fellow with the Center for Financial Security. And Ray Boschera, Director of Center for Household Financial Stability at the Federal Reserve Bank of St. Louis. And it's my pleasure to announce on behalf of Ray that the annual Household Balance Sheet Research Symposium will be held May 8th through 9th in St. Louis. The focus this year will be on younger Americans. For more information and for registration, please visit the link provided with Ray's information that you're seeing on the current slide. And just a reminder before we get started with the presentations, to submit questions that will be answered in the question and answer portion that will take place in the last 10 to 15 minutes of the webinar, please click on the Ask a Question icon in the bottom right corner of your screen and submit your question. And with that, I will turn it over to Erin Currier.
Hello, and thank you, Hallie, for the introduction and for inviting me to speak today. It is really a pleasure to be on this webinar, and particularly to be presenting with Hannah and Ray, who are two people that I greatly admire and whose work I follow closely. Hannah's paper on employment capital is really timely and so important, and my comments today will hopefully provide some context to her research and draw a connection between families' shorter-term savings and wealth accumulation and how that relates to their longer-term economic mobility. And that's a topic we've been thinking about a lot lately at Pew. Our project, the Economic Mobility Project, examines the health and status of the American dream. And our questions, our work focuses on questions that have really been front and center in a lot of research and policy conversations lately, such as how much equality of opportunity do people have, how likely are people who start at the bottom to rise all the way to the top. And today what I want to do is provide a really high-level picture of economic mobility in the U.S. and share data on the connection between economic security and specifically savings and wealth and economic mobility. Next slide. A good place to start is in the perception that Americans have about the American dream in general. So our project has conducted 2 public opinion polls over the last several years, and in both the polls and in focus group sessions, we heard very clearly that Americans believe strongly that the U.S. is and should be exceptional in its ability to promote opportunity. And even in bad economic times, considering that both of our polls occurred during and following the last recession, Americans are extremely optimistic. So even post-recession, 7 in 10 Americans believe they have control over their economic futures and that they have achieved or will achieve the American dream. Americans think that personal attributes like hard work and ambition are more important than outside circumstances, even a poor economy, in determining their financial success. And what's even potentially more surprising is that very few Americans believe that things like parental income or race influence a person's ability to climb the economic ladder. So the question, of course, becomes, are they right? Do Americans have reason to be so optimistic about their chances for economic success? Next slide. In order to answer that question, we study economic mobility, which is Americans' movement up and down the economic ladder within a lifetime and across generations. And there are 2 main ways that we measure mobility. We look at an absolute measure and a relative measure. Next slide. When we think about absolute mobility, what we're really measuring is how much better or worse a person is doing in absolute dollar terms. We adjust for inflation and for family size, and we can compare people to themselves over time or to potentially their parents. Absolute mobility typically occurs because of broad economic growth. So we like to think about it as an escalator. As the economy grows, people tend to move up as if they're standing on an escalator and sort of slowly rising. And indeed, when we look at Americans' absolute mobility over the last generation, we see undoubtedly a glass half full, because the vast majority of Americans have higher family incomes than their parents did at the same age. And that's true across the income distribution. This generation at all rungs of the economic ladder is doing better than the generation that came before it. However, even though a majority of Americans exceed their parents' family income, the extent of that increase is not always enough to move them to a higher or different rung of the economic ladder. And that is where relative mobility comes in. Next slide. So relative mobility looks at where people rank on the income distribution as a whole and whether that changes over time and across generations. So if someone's raised at the bottom of the income distribution, how likely is it that they remain there themselves as an adult, or how likely is it that they move to the middle? And when we measure mobility in relative terms, the glass is much more half empty, because we see that Americans raised at the top and bottom fifths of the income distribution are highly likely to remain there as adults. That's a phenomenon we refer to on where you yourself ended up as an adult. Then there should be 20% of the population would fall into each of the fifths of the income ladder. And in reality, you can see on this slide that 43% of those raised at the bottom of the income ladder are stuck there as adults, and 70% never even make it to the middle. Only 4% raised in the bottom make it all the way to the top, which really just demonstrates that this rags to riches story that we so like to assume happens in the United States all the time is really more prevalent in Hollywood than it is in reality. Similar statistics occur in terms of stickiness at the top, so the rates of people who are raised at the top of the income distribution falling out of the top. And what we know is that the United States actually has less relative mobility than other countries, including many Western European nations and Canada. Next slide. So this question of why so many more people experience upward absolute mobility than upward relative mobility is partly answered when we look at the income distribution and how it has changed over the last generation. So if you look at the column on the left-hand side, this is the way that the income distribution was divided, sort of the cut points for equal fifths of the income ladder in the parent generation. And then on the right side, you see those same fifths, but how they have widened out over time. And what that means is that median income has increased at all rungs of the ladder. The sort of cut points in between the different rungs have gotten further apart, but absolutely median income has increased more at the top than it has at the bottom. And that means that in order to get to the next rung of the ladder, adults today have to have pretty large income gains. So as a result, adults can have significantly higher incomes than their parents did in absolute terms, but in relative terms, they might still be stuck at the bottom of the ladder. Next slide. Those numbers show what's happening in the aggregate, but it's important to also highlight a really powerful finding that our project has, which is about the black-white mobility gap in America. What you're looking at is the gap in absolute mobility, and you can see that in those bottom three rungs of the income distribution, whites have a higher likelihood of exceeding their parents' family income than do blacks. But what's also important is to see that there's actually no data reported for blacks raised in the top two rungs of the income ladder. And that's because there just were not enough black families at the top of the income distribution in the parent generation to say anything statistically meaningful about their children. And that alone underscores huge differences between the economic security and family backgrounds of whites and blacks. There are a number of white families raising children at the top of the income distribution, but not as many black families. Next slide. We see a similar picture emerge when we look at black-white gaps in relative mobility. blacks are more likely to be stuck in the bottom than are whites, and they are more likely to fall from the middle. So even black families that have achieved solidly middle income status have a hard time passing on that socioeconomic status to their kids, at least a harder time than white families do. Hallie, you can go ahead and forward. I think that you might have to click a few times in order to get all of the bars to show up. So what you probably saw in the beginning was blacks being more likely to be stuck at the bottom, and now the slide should show blacks also being more likely to fall from the middle. Okay, so the big question for us is, what's driving these differences in mobility outcomes? You know, aside from sort of choosing the right parents, what matters for Americans' economic success? Next slide. What we have done with our project is to commission a host of research that identifies the factors that influence Americans' movement up and down the economic ladder. And we can divide these into three categories: financial, human, and social capital. You'll have to click forward so that each of the pictures sort of shows that. But the first one is financial capital. This would refer to financial assets that individuals acquire and leverage to get ahead, such as savings, home equity, and other investments. And if you click again, you'll see human capital. That refers to the skills and attributes acquired by individuals that impact whether or not they're able to take advantage of economic opportunities. So that would be things like education and health. And then, Hallie, if you click again, you'll see social capital. So social capital is referring to non-financial resources available to families. That's through relationships to people and institutions. Maybe that would be neighborhoods, your family structure, your professional networks. And today, what I want to do is talk about briefly some of our research that examines financial capital and economic mobility. Next slide. Earlier this year, our project issued a report called Moving On Up, and what we were trying to figure out is what's the difference between people who are stuck at the bottom of the income distribution over a generation and those who actually are able to move up. And this brief really demonstrated the importance of thinking about financial capital and economic mobility. What we found is that a host of factors matter for people moving out of the bottom over a generation. Post-secondary education is important. Race is important. Your employment status is important, and particularly whether you've experienced unemployment. But another really big piece of the puzzle is just having economic security broadly. And the families that were more economically secure were also the more likely to be upwardly mobile. So basically what we're finding is that those who left the bottom of the income distribution had 6 times higher savings, 8 times higher wealth, and 21 times higher home equity than those who remained stuck at the bottom. Next slide. This research also showed that movement up the income ladder was associated with movement up the wealth ladder. So of those who moved up at least one rung on the wealth ladder, over 3/4 also left the bottom rung of the income ladder. And nearly half of those who moved up a rung on the wealth ladder also moved up to the middle or higher on the income ladder. Now, so what does this mean? Because sometimes that seems sort of intuitive that wealth and income would be interrelated. Our findings are not meant to imply a causal relationship between savings and upward mobility in terms of income. It is absolutely not the case that if you go out tomorrow and put $200 in a savings account, you're not necessarily going to get a raise at work. You know, the savings and the income don't work that way in terms of the sort of cause and effect. But what we do think is going on is that people who are able to move up the income ladder and have a small cushion, financial cushion to rely on, are able to sort of solidify their place on the income distribution, on the income ladder, if they have some kind of an emergency financially or some kind of economic shock. So let's say that they have a car breakdown or they have something happen with their boiler breaking, and they absolutely need to be putting more money into that in order to get to work or what have you. Having that financial cushion gives them the flexibility that they need to do that and to not sort of lose ground on the income ladder at the same time. The other reason we think that these two are connected is that families can leverage their resources, their savings, or their wealth to invest in other mobility-enhancing things. So they maybe invest in education or job training, or perhaps they put savings into a home and then they're able to develop home equity. We think that what is happening is that there's a virtuous cycle of greater income mobility promoting greater savings and wealth, and then vice versa. And all of these things kind of relate to each other in a really self-sustaining and positive way. Next slide. So undoubtedly, the relationship between income, savings, and wealth is tangled and complicated. But as you can see from the data I presented, it is the case that short-term economic security and stability are connected to longer-term mobility. So in other words, achieving the American dream really happens one penny at a time. So that is the end of my formal presentation, and I will now hand things over to Hannah.
We have your slides up, and we are ready to start when you are.
Okay, great.
Thank you.
Well, thank you so much for this opportunity to share our findings from the Leveraging Mobility study here at IASP. My name is Hannah Thomas, and I'm a research fellow with the Center for Financial Security and a senior research associate at the Institute on Assets and Social Policy. Next slide. Today, I'm going to be presenting some highlights from the research project, Leveraging Mobility, housed at the Institute on Assets and Social Policy and generously funded by the Ford Foundation. The first part of my presentation will introduce the Leveraging Mobility study and give you some context of the trends and the overall data. The second part of the presentation will look at work's role in building and protecting wealth. And then finally, I will introduce some policies that we believe would help build greater access to employment capital for families as we understand this from the Leveraging Mobility study. Next slide. The Leveraging Mobility study set out to answer the questions, how do working and middle-class families use assets to advance security and mobility? And secondly, how do they struggle to gain ground in the absence of assets? Next slide. The study draws on a unique data set of in-depth interviews conducting at 2 points in time, offering a rare look at family financial lives and the decisions and trade-offs families made between financial security and opportunity during a decade of particular economic volatility. In 1998, the original sample of 180 families was selected to ensure that half the sample was white and half was African American, and that it had included an equal split of working class and middle class families. At baseline, families had children aged between 3 and 10 years old. More than 12 years later, these children were at the end of their high school career or beyond when the second wave of 137 interviews was conducted between 2010 and 2012. The parents are now in the latter half of their working lives, between 40 and 60 years old. The families were located in 3 cities in 1998, one on the East Coast, one on the West Coast, and one in the Midwest. At the time of the second interviews, the majority lived in the same city or nearby, and a few had moved to other states where they were contacted and interviewed. The baseline and follow-up interviews covered information about the children's education histories, the community or communities where they had resided previously and currently, their household income and expenditures, household wealth and debt, their work histories, family financial and non-financial assistance, and reflections about their economic security and decisions they had made related to using their assets. Next slide. So we looked to see what the reasons were that families saw their wealth increase. There were many variables that allowed families in the Leveraging Mobility study to accumulate wealth. Almost 2/3 of the families who saw their liquid wealth increase also increased their incomes. Increasing incomes are important for families to build wealth, but higher incomes are often a proxy for access to employment capital, which is what we call the non-income characteristics of jobs, which includes employment benefits. I'll return to the role of employment capital in building and protecting wealth in more detail in a few minutes. We also saw that extended family assistance played an important role in helping families accumulate wealth. 2/5 of families that saw an increase in their wealth had received some kind of financial assistance from their family members, and nearly 1/5 had received an inheritance. Extended family financial independence was also important. Many families, like the Perkins family, were lucky enough to have parents that had big financial cushions. Cherise and Brenton Perkins did not have to support their parents in old age, and they had benefited from access to parental resources to help purchase a house earlier in their lives, and this then provided them rental income when they faced work disruption. Home ownership and increasing home equity was another way that families accumulated wealth. Nearly 3/4 of the families who saw an increase in their total wealth were homeowners in 2010. Extended family financial assistance, interacting with this homeownership variable, often allowed families to buy a house. 9 of the 14 families that bought a house between 1998 and 2010 received some kind of family help, what Thomas Shapiro calls Head Start assets. To give you an example, Soledad Javelba, an African-American mother living on the West Coast, owned a duplex in 1998 that she had bought with help from her parents. By 2010, she had sold that property for $565,000 and took $225,000 in equity from that house to buy another house. That new house in 2010 was worth about $800,000, despite a loss in value from the Great Recession. Her net worth had grown from $164,000 in 1998 to $604,000 in 2010. While many families saw their wealth increase, about 1/3 of families saw their liquid wealth decrease between 1998 and 2010. If families are expected to be gaining wealth during this period of their lives when they are active and working, the loss of wealth suggests real economic hardship, family financial fragility for later years, and short-circuit opportunities for social and economic mobility for themselves and their children. Families that experienced a reduction in their liquid wealth were more likely to be African American, mirroring the data that Erin provided earlier. A complex set of variables contributed to a family's downward mobility in the study. This included health problems, change in marital status, unemployment, or a decrease in income, as well as a need to support extended family members, what sociologists call kin networks. To give you an example of the ways that supporting extended family members impacted families, we saw that nearly half of the families interviewed that had a wealth decrease between 1998 and 2012 were supporting a family member in some way. Family members included grown children who had left the household, adult siblings, nieces and nephews, and elderly parents. Contrary to the experience of Cherise Perkins, whose parents did not need her help, Lindsay Bond found herself caring for her mother for a period of 5 years, and this included covering her healthcare costs. This impacted her ability to build wealth. Next slide. When we looked at the data and asked what were the key elements allowing families to build and protect wealth, we saw that the characteristics of family members' employment were critical for families that we interviewed who were able to build wealth. And so we're honing in here on just one of the variables that I mentioned earlier. But we did see that not everyone had the same access to jobs with employment capital or this kind of wealth-building job characteristics. Some jobs provided real opportunities to build and protect wealth, while others did not. Next slide. As I just mentioned, we call the wealth-building and protecting characteristics of employment capital. We saw 3 specific employment characteristics as important to families who were able to build and protect wealth in the Leveraging Mobility study. The first of these were job benefits, which comprises retirement savings, paid sick and vacation days, health insurance subsidies, disability insurance, and tuition benefits. The second characteristic that we saw as important to families who were able to build wealth was job flexibility. This included modified work schedules around caregiving needs, compressed work weeks, job sharing, and paid personal days. And the third characteristic that was important for families who were able to build wealth through their employment was consistent work, including stable employment with no gaps between employment, long tenure with one employer, and sufficient hours to qualify for benefits. In the following slides, I'm going to offer a few examples of families who had access to employment capital and discuss the ways it helped those families to accumulate wealth. Next slide. The first family I will introduce is Margaret and Albert Dove, an African-American couple who have had access to many of the job characteristics critical to building wealth. They have been able to convert their employment into wealth through both income increases associated with their occupational positions and through non-income employment capital. In 1998, Margaret was a full-time, salaried with benefits computer programmer and human resources manager for a hotel chain, a job that she'd held for 10 years. By 2010, she was working for a new company as a senior manager, a higher level position than she had in 1998. Her husband, Albert, worked for the city administration in the same position he had held in 1998. In 1998, their household income was $75,000. By 2010, it had increased to $160,000, primarily because of Margaret's promotion. They had $230,000 in retirement savings, a result of steady contributions matched through her work-provided retirement plan over the course of 20 years. Their health expenses were low because Margaret had access to good health insurance through work. She didn't have to buy her own life insurance since it was provided by her employer. Margaret and her husband both worked for the same employer for many years. Margaret worked in her first job for 18 years and received a stock option when her employer was bought out. She was eventually laid off, but due to her job tenure and level, she received 1.5 years of severance pay, close to $100,000. When she left and started looking for a new job, she didn't have to touch her 401k, which had about $60,000 in it. In 2010, she had been working for her current employer for 10.5 years and had invested in a new retirement savings account. It was her length of employment with a single employer that qualified her for this benefit. Longevity also qualified her to take the full retirement savings, her own and her employer's contributions with her. So she had real access to employment capital through those years of work, allowing her to build significant assets that she could maintain and build towards retirement security with. Next slide. Another example of a family where employment capital played an important role in building and protecting wealth is the Adams family. Anthony Adams is an African-American mother of two living in an East Coast city. In 1997, just before we interviewed her for the first time, Anthony completed a certificate program at the university where she was employed. She was able to move forward from a part-time job to a full-time administrative position at the school. By 2010, Anthony had taken advantage of the university's policy of providing education as a benefit and had earned both a bachelor's and master's degree. She earned significantly more, receiving promotions and income raises as a result of that education, enabling her to build up a matched retirement savings account totaling $100,000. Despite halving her retirement wealth in a divorce settlement, Anthony still held more wealth in 2010 than she had in 1998, a result of her access to employment capital. Anthony also had an employer-sponsored college tuition benefit for her children, which paid for her son's college education. She continued working at the university so that her son would be able to go there tuition-free. All she had to pay for was his accommodation and books. By 2010, her overall increase in wealth was in part due to not having to pay for college for herself or her son, freeing up additional income for savings. As she put it, "My 30 years was my children's college savings plan." Another example is Letitia Curley. In 1998, Letitia, an African-American mother of two, was working for a county social services organization. By 2010, she had been in that job for more than 20 years and married someone who also had 20 years tenure in his job. Between them, they had built up between $300,000 and $500,000 in their work-based accounts as a result of their own and employer contributions. Combined with a pension plan, they had significant retirement security. Many families in our sample experienced the wealth-building benefits of employment capital. Others did not. And I want to make sure that I said next slide, we're looking at when employment capital is missing here. Identifying where employment capital is missing informs our understanding of its critical role in wealth building. Without access to employment capital, families were not only less likely to build wealth, they were also less likely to be able to protect their wealth in times of joblessness or underemployment. The wealth-building experiences and perspectives of those families without employment capital are quite different, as the following examples demonstrate. Without retirement, just over 1/3 of the families interviewed did not have a retirement account. Felicia and Simon Ward were one of those families. Felicia was disabled and Simon was self-employed. Although they had managed to buy a house, they had no retirement savings. When asked about their retirement plans, Simon laughed and said, "What's that? You mean dying? Expiring? I got some bottles downstairs, cans and bottles." His wife chimed in, "That's our retirement." Without retirement savings, families have less financial security for their future, and they do not have the capacity to use those savings in an emergency. When families don't have health insurance, the Affordable Care Act will likely address for many families the challenge of being unable to access health insurance through an employer. However, families in the Leveraging Mobility study told us how the absence of health insurance created stress and worry about medical costs and created financial insecurity. When interviewed in 2010, Darlene Oxford was unemployed, did not have health insurance, and she could not afford to buy insurance independently on the market. When asked about health insurance, she responded with the fear that illness could lead to debt, which could lead to home loss. "No, I have no health insurance," she said. "I keep telling my son, don't get sick. We can't afford to get sick. Because I own a home, I'm definitely afraid of anybody sneezing around me. If I get sick, they can sue me for my home, and I just don't have it." Without job flexibility. In our data, workers who needed job flexibility, primarily for caretaking, frequently had to leave jobs and find alternative employment, often not as well paid and or without benefits. In some cases, they were unable to find employment. Sandy Doherty, a single mother, left her job with a unionized employer that included significant employment capital with benefits like paid sick and vacation time because of the lack of flexibility in responding to her needs as a parent. She says, "Sarah was about, almost 11, and I just kept kind of dreaming of the day that I would just be able to be a better mum and be more available. It was like I want to take my kid to the theater and soccer and acting. So it was always both a tough job, because either you have to make up excuses and sort it out, or just use your sick time, and you're taking a risk. You're always risking lying about it, or whatever you're doing to accommodate your family and be a good mum, versus working hard and making money." Without consistent employment. For those unable to find consistent work, building wealth can be a hard prospect. Laurie Meador didn't have a consistent employment record through no fault of her own. In 1998, she worked for a social services organization and saved into a 401k plan. She changed employers a few times and then was laid off in 2006. Unemployment insurance didn't cover the household budget, so she cashed out her 401k to support her family. When she began working again, she had started taking care of her aging mother. As a result, she could go back to work only part-time. She did have a matched 401k and health insurance at her new job, but it meant building only on the foundation. She wasn't able to build on the foundation of the 401k she'd had with the social services organization. She was starting anew. Next slide. Not everyone has the same ability to access employment capital. Some occupations and jobs are more likely to have employment capital than others. And so for those workers who are missing employment capital, they have regularly experienced the kinds of problems that those interviews and examples illustrated. Self-employed workers part-time workers, and low-wage workers have less employment capital. Some occupations, for example, service sector, like restaurant workers, have less employment capital. So these workers have fewer avenues to build and protect wealth. Next slide. So this research reveals the importance of employment capital as a significant contributor to family wealth, economic security, and well-being. There are many potential policy directions that could strengthen and expand workplace employment capital to build and protect wealth, and I'm going to go over a few of these right now. We could incentivize and encourage long-term savings plans and healthcare utilization for employees across all income levels. We could increase ease of access to and portability of retirement accounts by reducing enrollment and vesting periods for new hires. This ensures that when employment ends, a worker can have access to their contribution and their employer's contribution without a penalty. We could establish some minimum employment capital standards and require government, both state and federal contractors, to meet these standards. We could require all employment capital opportunities are made available to all workers employed on behalf of a firm, whether they are full-time, part-time, contract, or temporary. And if necessary, provide publicly run marketplaces for smaller employers to access retirement accounts and other employment capital opportunities. We could strengthen access to worker representation in the workplace. Unionized jobs and jobs with significant worker input tend to have more employment capital available to low-wage workers than those that don't have worker representation. We could promote job sharing and job flexibility to reduce work-family conflict. And we could mandate a minimum number of sick and vacation days for workers to reduce work-family conflicts and to reduce wealth depletion due to unpaid work days. These are just some initial policy ideas to build equity and access to capital that can help workers build and protect their wealth. I've touched on the key characteristics of employment capital in this webinar, but we do have a follow-up webinar with PolicyLink in March that will explore in more depth the inequities in access to employment capital. If you're interested, please follow us on Twitter for updates about this webinar. Our Twitter address is IASP_Heller, Heller. I'm going to finish here and hand over to Ray Bashara from the Federal Reserve Bank of St. Louis, and I look forward to more discussion of these ideas and our findings in the question and answer session.
Yes, hi. Thank you very much, Hannah. And let me just state as well that I'm so impressed with your work and Aaron's work at Pew. I've relied on your work a great deal over the years, and it's a pleasure to be working with you here. So these are my own views and not necessarily the views of the Federal Reserve. I'm sure you're all used to hearing that. So I know that we're running behind. I'm going to go through my slides quickly so that perhaps there's still some time for some Q&A. The financial capital and the employment capital are of course, critical parts and contributors to a family's overall balance sheet. What I'm going to do here is just dig a little bit deeper into this idea of the family balance sheet, talk about the losses, talk about the recovery, where we are now, a little bit about younger families, and then I'll close with some policy implications. So why are we looking at balance sheets, family balance sheets? Many of you have been working in the asset building field for many years, and I think because of the significant role that debt played in bringing down both families and the economy, I think the proper framework now is the broader family balance sheet. We have to consider the role of debts in family mobility and stability. But also when we look at balance sheets and try to distinguish that from other measures of economic well-being, income, jobs, we have new insights into how families and the broader economy move forward. So let me start with my first slide, family wealth losses from the recession. I hope you're all seeing that slide right now. What we did was try to look at what are the key demographic drivers of balance sheet health. And in this first slide, we were trying to see which families lost wealth from the recession, which ones lost the most amount of wealth. And as you can see, if you look at the three highest bars there, by far, the families that lost the most amount of wealth were younger, historically disadvantaged, African Americans or Hispanic, and less educated families. Compared to families that were older, white, or with more education, the wealth losses were rather significant. 37% there was a 37% wealth loss for minority families, a 44% loss of wealth for younger families, and a 26% wealth loss for families with no high school from 2007 to 2010. So we tend to focus on these demographic drivers because they tend to be more stable, a little bit more reliable than income as a predictor of balance sheet health. So the key point here is that age, race, and education are very powerful predictors of who lost wealth from the recession. Next slide. When we look at the recovery of the wealth that was lost in the recession, to simplify things, we've basically put people into two categories, thrivers and strugglers. Now, the headline was that we've more than recovered the $16 trillion of wealth lost in the recession, and that household deleveraging, paying down debts, and rebuilding savings is over. That's been the headline for the last several months. And as a matter of fact, just today, the New York Fed pointed out that families are actually re-leveraging, taking out more debts, whether it's mortgage, autos, or student loans. This is actually true, that there has been a pretty robust wealth recovery for about 1/4 of the population, those we call thrivers, those who are white, better educated, and middle-aged or older. However, the recovery is not true for strugglers, the 3/4 of the population who are less educated, non-white, and younger, by which we mean under age 40. And for some families, the loss of wealth may be permanent. Now, if you try to unpack the recovery, if you break down the recovered wealth over the last few years, what's going on? It turns out that it was largely a growth in the stock market that has accounted for the vast majority of recovered wealth. And not surprisingly, thrivers have a disproportionate share of that wealth. So because they have that wealth, they have been able to recover. Because they have stock market wealth, they have been able to recover their wealth pretty quickly. However, housing, where most strugglers have their wealth, has contributed only 12% to the recovery. So you have these headlines saying we've recovered the wealth, we've more than recovered the wealth. Well, in fact, it's been very uneven. If you have stock market wealth, great. But if you're like most Americans and most of your wealth is in housing, your recovery is far from complete. So this explains the sort of the incongruence between the headlines and how most Americans are feeling about the recovery. It still feels sluggish to them because in part their balance sheets are far from fully recovered. Next slide, please. So I'm not going to go through all these numbers. This is mostly for your reference. This is data that you won't find anyplace else. We did our own estimates of where families now stand as of the third quarter of 2013. I've included this here for your future reference. But I just wanted to make a point about how much age, race, and education really matter in predicting who has wealth and who does not. You can do this on your own, but if you were to compare some of the far right columns, you will see that even among the best educated families, those with college degrees or higher, there is still a difference of 3.5 to 4 to 5 times the amount of wealth between African American, Hispanic, and white families. Race matters, even among families that have a lot of education. And you can do similar comparisons by looking at these numbers on this table. Next slide. The one area where I wanted to dig just a little bit more deeply is age. As you saw from some of the previous slides, age, race, and education were the three strongest predictors of who lost and recovered wealth, with age, in fact, being the strongest predictor of who actually lost and recovered their wealth. That's true for the recession. What the chart you see in front of you says is that this trend of younger families falling behind in terms of family wealth actually goes back even further. If you look at what's happened to family wealth between 1989 and 2013, you can see, if you look at the top line, the green line, older families, those 62 and over, have almost doubled their wealth in real terms. For middle-aged families, those ages 40 to 61, their wealth is almost two-thirds higher than it was in 1989. But for for younger families, those in their 20s and 30s, in real terms, it's actually lower than it was in 1989. So this is a longer-term trend, and I think the recession exacerbated these longer-term trends that were not favoring younger families. And in fact, you can go back even further, and it turns out that families born after 1950 are on track to be the first generation in history to have lower levels of family wealth than their parents or grandparents. Throughout history, each generation has done better than the previous generation in terms of their family's wealth, but today's younger Americans are on track to be the first generation where that is not true. And we're not just talking about life cycle effects. We expect people who are younger to have less wealth. I'm talking about a life course perspective where the curve is lower. They're going to start with lower wealth, and even when their wealth peaks, it's going to be at a lower point than it was for previous generations. Final slide, please. So what are some policy implications of this work? I endorse Hannah's recommendations around building employment capital. Let me just add a few more things that would both boost employment capital, but also the health of the broader family balance sheet. So first, we tend to focus a lot on income. I think our data make it clear that age, race and ethnicity, and education are really critical drivers of balance sheet health, and that we should target our resources along those demographic lines where possible. Second, I think through employers and others, whether it's a nonprofit, a VITA site, financial institutions, credit unions, we need to help families meet their liquidity needs through unrestricted savings and quality short-term credit products. And when you have access to short-term capital, whether it's good loan products or savings, the health of your balance sheet improves. Better access to financial services, you can pay down high-interest debt, you can absorb a financial shock more easily, and you have the resources to make investments in longer-term assets. I just want to reinforce the critical point that Aaron made earlier about how having some financial capital, especially liquid capital, really is key to both financial stability and economic mobility. Third implication, encourage employers to offer automatic deductions for longer-term savings, especially post-secondary education and retirement. I think this mirrors something that Hannah said. Getting families on autopilot for their savings is critical. Many families, of course, don't have access to those kinds of benefits. Some of the real innovations that are out there try to provide automatic payroll deductions, either for college or for retirement or for short-term savings for families that don't have those kinds of benefits in the workplace. Automatic deductions are set up into accounts that exist outside of the workplace. I think those proposals merit further consideration. Some of you might be familiar with the administration's MIRA proposal, and I know that the administration is now looking for employers to pilot that idea, which would be basically starter retirement accounts for low and moderate income workers. Fourth, diversify family balance sheets beyond homeownership. One of our key findings is that it was really overinvestment in homeownership that devastated the balance sheets of younger, minority, and less educated workers. And those who bounced back were the ones that had not only stock market wealth, but financial assets, real assets, business assets, a whole range of assets. I think the key goal that all of us have to work towards is a diversified balance sheet. And a great way to get to that point is to start with some kind of unrestricted or flexible savings. And then finally, start building healthy balance sheets as early in life as possible, ideally in schools linked to 529 accounts. Especially given the balance sheet challenges that younger Americans are facing, it might be too late for many of these families to wait till they get a job to start building wealth. Starting when they're born or no later than when they start school would be a great place to do that. And defaulting families into college savings plans or savings plans when they enter kindergarten would be a great way to get on a path towards a healthy balance sheet. Thank you.
Thank you so much, Ray. And I think we have a couple minutes for some questions that have been posed by our listening audience. Thank you to those who submitted. So first question, I believe it is intended for Hannah to take a crack at it. The question is, so there's been a lot of debate about paid sick leave legislation that's being promoted in cities and states around the country for both public and private sector workers alike. How does this legislation affect today's topic of mobility and employment?
So thanks, Hallie, for this question. I think that the proposals, there are quite a few proposals that are on the table around the country, as you mentioned. I think providing some forms of paid sick leave would really go to addressing some of the work-family conflicts that families experience and that we saw families really experiencing in the Leveraging Mobility study. Too many of the families that don't have access to paid sick leave are families that are on a low-wage end, part-time or temporary workers, and these are the families who we saw really lacking employment capital. And one of those aspects is the kinds of flexibility that paid sick time would provide for them in order to be able to attend to their own or family members' needs when they weren't well. So I really see those proposals that are on the table around the country in different cities, states, and states would really be building aspects of employment capital. They wouldn't be the only piece needed, and there are many other ways to build job flexibility and other aspects of employment capital. But I do think that those policy proposals that are on the table would go some way to addressing the need of families for paid sick time.
Thank you. And I think I'm going to just have one more question before we cut it off. And then, of course, if people in the listening audience have additional questions, feel free to email them to me, and I'll pass them along. But the final question, how are we actually able to measure employment capital? Can we get national statistics on employment capital? And I think this question might be appropriate for Hannah, and then you can pass it along, Hannah, to either Aaron or Ray as well.
Sure. So that was actually one of the challenges that we faced, and I think where the Leveraging Mobility study really gave us some in-depth insight was in seeing some of the ways that we could expand our understanding of employment capital. We really can't look to some of the standard data sets that we might use for the Bureau of Labor Statistics data or the Panel Study of Income Dynamics to give us information on both wealth and employment capital. So we can't, for example, determine if a worker in one of these data sets is able to build wealth and, for example, has access to a job that has retirement savings or a job that has health insurance and tuition benefits. We can't see the full package of employment capital in some of these data sets. So our thinking was that we actually do need to expand some of the data that we're collecting to get a better understanding of the inequities in employment capital and in order for us to make really strong recommendations for expanding employment capital. I don't know if Ray or Erin, you may have additional sense or more thoughts to add to that.
Nothing for me.
Nothing from me either.
Okay, I'm going to change my mind and ask one more question then, just because I think this is a quick one and it's good for our viewing audience to know. Hannah, will your organization continue to follow the families to allow for some longitudinal data?
Yes, yes, I think that the plan is, if we can get additional funding, to look in 10 years. We hope we'd be able to take another look. This is a longitudinal study already. We had the interviews in 98 and 2010, and I think we would really love to follow up in another 10 years. I don't know if I'll still be here, but hopefully the organization will be, and we can conduct more interviews with those same families.
Great. So with that, I really would like to thank Erin Currier, Hannah Thomas, and Ray Bocera for their excellent presentations and insights on the topic today, and for their patience with our technical problems, and for our viewing and listening audiences' patience as well. Thank you so much for tuning in today, and please let me remind you that the webinar will be archived on the CFS website, cfs.wisc.edu, and I will also be posting the copy of the PowerPoint presentation as well. And I also wanted to note that next month we will be featuring a webinar, March 25th from 12 to 1 p.m. This webinar will be on tax code knowledge and behavioral responses among EITC recipients. So stay tuned for that registration email to come.